Hello, good morning, guys.
Teacher, good morning.
Good morning.
Hola, buenos días a todos.
Hi, teacher. Good morning.
Hi, good morning.
So today we are supposed to see a scenario analysis and finish two other indicators for valuation purposes analysis. That is payback period. Well, actually, there are three. It's payback period, discounted payback period, and terminal value. And scenario analysis is not that hard. It's basically what you've been doing so far. Not only on this class, but also in other classes, which is just modeling financial statements pro forma in Excel. For that, I will tell you what is scenario analysis, what are like the caveats you need to be taking into consideration when doing that. And also I will show you two tools that are really useful inside Excel to do scenario analysis. So today's class, I'm thinking is not going to be as long. Well, I hope it won't be as heavy as other classes. So before we start that, I've been reviewing some of the homeworks, and after seeing like a lot of you had a lot of questions for the homeworks, I would like to propose to you guys, maybe today we can have like first like a general review session on answering questions. Felipe and I, we can help you with that. And then we can move on the topics we are missing to end today's, to use fulfill this week curriculum of the course. So if you guys agree, we will start today with questions. You can ask questions, and maybe they are the same questions some of your classmates have. Also, I will give like some general considerations I saw in a few of the homeworks I've been reviewing. And I want to tell you also that even though homework was due yesterday, I will still leave the link open today. So you can, in case you want to change your answer, you can re-upload your file. I didn't did that as a comment yesterday because I wanted to review with you guys first, if you agree with that, and if you wanted to have like the review session today. So what do you guys say?
Yes, I think it's okay.
That sounds
Yes,
nice.
teacher,
Yeah.
please.
Yes. So I need it to be a general consensus. Just like two of you have said yes. The rest would like me to just continue to read the class.
The review sounds nice.
Yeah, I think it's a great idea to be able to review the homework.
I want to make a poll, and the question is, oh, I cannot do it. So maybe I wasn't clear. I don't want to like review the homework with you because I want you to work on the homework. What I want to do is review questions you have on the homework, and then make some comments regarding things I've seen on the homework. So what do you want to go first? Do you want me to like do the general comments? Maybe there are your questions that you have, or maybe you want to ask the questions and I will answer you.
General comments, because I really don't know what I'm doing, if it's okay or not.
Okay, so I want to start with a question. Actually, Frida had yesterday. She sent me an email asking me, and I think it's actually a great question because this question is actually related with it is related with the case, and it's related with something that happens in the when you are doing valuation. Actually, just let me with three. And it's gonna be screen 2. It has to do with cash flow statement and the free cash flow analysis. So Frida pointed out that if you were to apply this formula inside your cash flow statement and try to get your free cash flow, you actually end up with a different number, because here I told you to start with operating activities and then reduce interest expenses. We all know why we are reducing interest expenses and well, I'm sorry, increasing interest expenses and reducing the tax shield, right? That this part now, I mean, this part should be clear for you now, guys. It's because of WACC. Because in WACC, you are actually when you discount the free cash flows, what you are doing is actually taking back the interest and adding the tax shield. That's why you have in the formula for WACC, you have the interest like it will be debt between debt plus equity times the cost of debt times 1 minus the tax. All right. So that part of the formula is actually adding up the interest, the tax shield on the interest expense. That is this thing here. This is the tax shield. And when you put the interest rate inside the WACC as a discount rate, which is all of this, I mean, the complete part of the formula, this is the interest. And then when you use that to discount the cash flows, what you are doing is discounting it back. So that's why we added up here, because if we didn't, then we will be discounting it twice. So what Frida pointed out is that if you take this one and then you do this formula in the case and reduce it like CapEx, what you end up is just the cash generated on the investing activities. And if you remember in the course, I told you to, for the case scenario, I told you to take the cash generated at the end of the period, which will actually include financial activities. Financing, I'm sorry, activities, all right? Now, why did I tell you this? Well, the reason I told you that is because in the case, it is stated that there is an increase on the cash flow usage for the business of 25,000 pesos, which is actually meant for Fernando to repay the debt, but it's not a debt payment yet. It's just for the projection is considered as it will be considered as debt payment, whereas it's not yet a debt payment, but only like an increase on the cash flow used by Fernando. For the case it's considered as an increase on working capital. All right. And if you remember working capital in the, you were supposed to review working capital in other courses. Working capital is the money that you need the next period to increase your operation capabilities. So by increasing working capital, I mean, by deducting it inside your cash flow, you are supposed to do it in free cash flow. Actually, if you go to this formula here, you can see it here. Working capital is here. The reason why you do this is because you are expecting to have an increase on operations next month. So what I didn't tell you about this one is that in the case you are taking into consideration working capital in the case scenario by specifically, and that's why I told you in the cash flow statement, you are, for this case scenario, you are supposed to use, let me open the other PowerPoint. This line here, cash generated in the period, all right? Here. And that is for the case scenario, because as I told you, when you read the case, it tells you that Fernando needs 25,000 pesos extra to repay his debt, but it's the idea that he has, which is taken by the case, and by the case solution actually that they gave us, it's taken as an increase on working capital, as Fernando will need that money to, the idea is to repay the beginning idea is to have the money to repay the debt, which if it were the case, then it wouldn't be included in the free cash flow, because if you remember the free cash flow definition, it's the income generated by operation basically, and capex investment. So income, no cash flow, I'm sorry. So if we just follow definition, then this value shouldn't be included. But in the case, it is stated that the idea is to use it to pay the debt, but it's actually just an increase in cash flow outflow that you are taking into consideration as the projection moves forward. So the case takes it as an increase in working capital, and that's why we are taking it. And you are supposed to take it in the analysis. So that's the first note that I will make. Frida was the one that sent me the email telling me that, hey, teacher, I'm seeing this difference, and I would like you to explain to us. So I don't know if it is clear now, Frida.
Yes, teacher, thank you.
Did you all guys understand that, what I explained?
Yes.
Yes, and I want to ask like a general question here, like for all you guys to answer. Are you guys understanding the thing about generating the cash flows, and what is the cash flow we are taking into the net present value analysis, internal rate of return, and all the analysis we are doing, and why?
For me, it wasn't clear, teacher.
Personally, I also have doubts about that.
And why is the reason we are using cash flow to evaluate? Or what part of the cash flow we need to use to evaluate?
I think the cash generated in the period.
Okay, yeah, but my question is, what part of that is not clear? Like why we are using it, or what part of the cash flow we need to use?
Why are we using it?
Okay, so it's the same question for you, Citlali. Thank you, Aranza.
Yes, teacher, same question.
So we are using cash flow to evaluate this because when you do evaluation of a business, you are supposed to take into consideration the cash generation capabilities of the business. Remember, I told you in the first class, what is the main, and it sounds like motivational. I mean, I know I sound like a motivational speaker saying this, or demotivational speaker maybe. Remember what I told you at the first class. What is the main objective of a company? I mean, you start a company, and what is the reason why you start the company, you start the business? You started it, sorry, because you want to generate cash. That's the only reason, financial perspective, you start a business. You start a business because you want to generate cash. So the calculation of cash flows in a pro forma analysis, that is a projection. What we are doing is called pro forma. That's the technical way to put it. The financial statements are called pro forma in the projection analysis we are doing. And the reason we are using cash flow is because that's the main way of evaluating a company, as you are supposed to generate cash flow inside a company. And that's the main objective. Well, actually, I want to show you something. So I was reading these articles. You are seeing my screen, right?
Yes.
So I was reading this article. This article is about the second wave hitting, and EasyJet is about to, I mean, most likely will go bankrupt, and a lot of large airlines will go bankrupt. And the reason is because sales are going down, and well, cash is going down. What I want you to see at this news. Look, it says Morgan Stanley to buy Eaton Vance a $7 billion deal. You know what? I mean, you know the company Morgan Stanley. I mean, can you recognize the name? Aranza and Citlali, which were the ones
I
who asked the
don't.
questions. Morgan Stanley, it's an investment bank. It's a huge US bank, right? And what they do is actually, well, they lend money. Basically, that's the main business of a bank. And it's a huge bank in the US, and they just bought Eaton Vance, which is another huge wealth management. And wealth management, I mean, do you guys know what BlackRock is?
What?
BlackRock, this company?
No.
I was also reading about BlackRock here. BlackRock is the biggest wealth management in the world, and this is a company. BlackRock is actually the main creditor for Argentina's national debt. It's also a U.S. bank. It's huge. It's a huge company, and what they do is they invest in assets, and they generate money by investing. One of their main or core business is actually investing in sovereign debt. What I'm trying to show you here, guys, is what is the reason we are using cash flow to evaluate a business performance? Well, it is used in general business analysis, okay? So this news here that you are reading in the screen says Morgan Stanley used to buy Eaton Vance, $7 billion deal. They just bought a company by $7 million, they did it yesterday, and this just peaked the valuation for Eaton Vance, okay? Because what's happening here is that the cash generated by the business is expected to grow, and it's expected to grow because Morgan Stanley is going to put business money in the business. So where can you see that increase in value in the valuation? Well, you can see it in the stock, and I was actually watching the stock. I was thinking, well, if I had known this before, if I had insider trading knowledge, I would have buy a stock of Eaton Vance yesterday, you know, and today just look, I could have bought it like a 40, and now I could sell it like 60, you see? And the stock value of a company is actually the market capitalization is the value of the company. So what I'm showing you guys here is the reason why we are using cash flow statement and cash flow analysis to review valuation for a business and for any project investment actually, because it is used in general investment analysis. All right. I mean, what you are watching here today and what we've been reviewing so far, it's not just for academic purposes. I mean, you are going to use these tools in case you want to. I mean, if you choose a professional career in finance, either if it is on a stock market and money market analysis, you know, for lab career, or if you are inside a company and you are doing mergers and acquisition as an accountant, which will be what Morgan Stanley did here with Eaton Vance, you will also be using these tools. So it's all based on the cash flow statement and the cash flow. I mean, it's all based on the cash flow generated by a business. And I am showing you guys how to do it with the cash flow statement, as the cash flow statement is one of the first of the 5 fundamental financial statements you will find in a business. So we are using that because it is generally used everywhere to evaluate companies' value. And it's also, and we are using the cash flow statement because if you want to do an analysis of an asset outside text class purposes, what you will find out there is going to be cash flow statements for publicly traded companies. So that's why we are using cash flow. That's like the reason why. I don't know if that answers the question that answered Citlali, like why we are using cash flow to evaluate.
Yeah, for me it was more clear and I understand.
And Citlali?
Yes, teacher. Thank you.
Yes. Now, in a more technical note, why are we using this one? Well, in the case, we are, of course, using it because the explanation I told you, it is required for us by the teacher's response. The educational note is called that we use that number because we are turning the 25,000 pesos instead of being debt payments, which will actually disqualify them for free cash flow analysis. We are using that number because we are treating that increase on cash flow outflow as an increase on working capital, and that's why we are including it. But in the future, in case you are doing analysis by your own, yes, you will be using this number here, the cash flow from investing activities, and you will actually add up the interest expense and also reduce the tax shield. Following the formula you saw, you can following the formula you saw here in this. Following this formula here, all right? That will be for in case you wanted to do an analysis. Maybe you are going to buy stock, or maybe you want to help in your family's business to analyze the value of the company to take decisions, or maybe inside your family business you are going to take a decision of investment. You can use this formula here and you will get the correct result. Okay? So
Teacher, my Wi-Fi kind of went out for a little bit, but my a compañero, they mentioned to me that you talked a little bit about WAC, and I think what you said was not the way that I did it. can you mention how can we find the WACC properly again, please?
Okay, so yes, of course. I mean, if cash flow, cash flow is the base for the analysis. So if you don't have any other questions about cash flow, I will move to WACC because that was the other thing that you guys asked me a lot with email and remind me message. So before I move to your question, Brenda, I would just like to ask if you guys are all in the same page with me regarding cash flow.
I think yes.
Okay.
I only had the doubt, but apart from that, it's clear for me.
Okay, you don't have it. I mean, I didn't understand that answer. You have another question regarding cash flow?
Oh no, that apart from the doubt that I had before, that it was all clear for me now.
Ah, okay, perfect, perfect. I'm trying to stop here for a minute just because I saw a few of your homeworks where you guys were actually using the accumulated cash flow. You were using the number going when you have a cash flow statement, you have here two other values. You have the cash generated here, cash at the beginning, and then cash at the end. And you have a number here. I think it was 30,000 at the first, and then you have 72,363 for March. And you guys were using this number to calculate discounted cash flows. That is the net present value. This is not the number you are supposed to use. The number you are supposed to use is this one, 42,000. All right, because it's the cash generated by the business in the period. This is the cash accumulated. This is the cash saved by the business in a cumulative basis. It is there because it is a part of the report. I mean, the cash flow report must show that, so you can check it with the balance in your bank statement, but it's not the value we are going to be using for cash flow analysis. I mean, for discounted cash flow analysis, you need to use this one, the 42,000. All right. So some of your homeworks, some of you guys deliver homeworks where you are using this number. That will be a disqualification. That will be like I will have to grade you to give you a bad note if you actually are using this one. And I saw it in a lot of you guys. So what I'm telling you now is please change that. Please re-upload your file and use this one. And just a quick note, I am allowing you guys to do this because it was like a general mistake a lot of you guys did. And I don't want to move forward with that because that means maybe I'm not explaining myself correctly. So that's why I'm telling you, re-upload your file, change that, and just don't just change it because I'm telling you. Understand that the reason you have to change it is because you are analyzing the capability of the business to generate cash flow, all right? And the cash flow generated by the business is this one, is this line here, 42,000, not this one. This is the cash saved by the business, all right?
Where do we use it, Profe?
For the net present value, for the internal rate of return, for the modified internal rate of return, for all the analysis we are doing, you need to use that value there.
I have a question. I already changed it, but it gives me a negative number. I don't know if that's right.
Well, that's another thing I want to tell you guys. The investment, most of you are taking, it's not the investment I was talking about. And there, I'm gonna give you the number. Just let me move forward to the question Brenda had, because I wanted you guys to read the case and find the number I was telling you, but it wasn't clear. So I will review that with you in a moment, because I know why it's giving you a negative value, Isaac. It shouldn't actually, but I know why, because you have an investment of 3 million and something, right? Like initial investment.
Yes.
Yeah, that's the reason why. That's the investment at the beginning of the project Fernando had, and I was telling you to use the debt pending balance at the beginning of the project valuation, which is in March 2006. All right, because he already paid most of that debt. Anyway, we're gonna do that. We're gonna see that exactly when we review net present value analysis, which I will do. But before we do that, Isaac, I will move to Brenda's question, which is actually for the WACC, because some of you guys were actually doing that incorrectly as well. So let's go to WACC. And please, if you have any questions, just as Isaac and Brenda are doing, just stop me for me to explain it to you, all right? So this is WACC, weighted average cost of capital. Again, it is one of the three main type of rates you usually use when you are doing net present value analysis, discounting cash flows. We are using weighted average because it's the most used in the industry when you are doing an analysis. Risk-free rate is also used, but that's just like more academic purposes, or more like like um, like debt-free projects use risk-free rate like for comparison to the risk-free cash flow. So first, we are using WACC because it's the most widely accepted use discount rate for for cash flow, discounted cash flow analysis. So the weighted average cost of capital. What I noticed, I mean, the idea of the WACC to change every month was for you guys to actually practice how to do WACC, because it's a really straightforward formula. It's actually pretty easy to calculate. So I didn't want you guys to only calculate once and just have it like that. In the case scenario, the idea was for you guys to calculate WACC each month, because debt changes each month, and also because tax change between years. So those changes will actually change your WACC analysis. And then I told you in the remind session that after you calculate a WACC for each month, you just take an average of all the WACC, and that's the average WACC for the project. All right. What I noticed is that some of you were actually applying the formula wrong. So we are going to review the formula, and I just want you, I mean, just don't think about the formula as the formula and just plug values in, because you are just gonna forget it, and maybe when you are doing the case, you will not find the values to plug into the formula. So I will review the formula and will be explaining what the values inside the formula are, the variables that you have to fill in. Just don't think just as plugging in values and that's it. Think about understanding the analysis of WACC, so you can actually apply it correctly, not only in this homework and in your case scenario you will deliver at the end of the course, but also if you use them later. So this is the formula for WACC. WACC is a weighted average. I mean, in Spanish it's called promedio ponderado. All right. And what that means is that you actually take into consideration the weight of the values inside the total. All right. So that means that if this were to be a pie, you know, let's say that this is 25% of the value and this is 75% of the value. All right. So if I were to tell you that this is worth 100 and this is worth 120, and then I ask you what is the promedio ponderado, and I'm using it in Spanish because you most likely heard the concept in Spanish, all right? But it's the same as saying weighted average. These two are the same. This is in English, this is in Spanish. So if I were to ask you what is the promedio ponderado of this, or the weighted average of this, what would you do? What would you do, Brenda?
120 times 0.75 or 100 times 0.25.
Exactly. You will just do this and add them up, right?
Yes.
And that's the weighted average. That's the promedio ponderado or weighted average. Well, when you are doing WACC, that's the thing we are doing. And this here is the financing of the business. And financing of the business, if you remember your balance sheet, you have your assets, and we say that to buy your assets, you need what? You need debt or liabilities, and you need what? Investment, that is equity. So what we want to know is what is the value of the money we use, I mean the cost of the money we use to buy all these assets, because assets are supposed to generate what? Cash flows, all right? And remember, it is all linked to cash flow. Everything, bottom line, is cash flow, cash flow, cash flow, money. So what you want to analyze is what is the cost of that generation of money, of that cash flow. And if we know that cash flow comes from the assets we buy inside the company to generate those cash flows, then we need to know what is the cost of debt and the cost of financing of investment on those assets. So that will be the liabilities and equity cost. And the liability cost is the interest expense, and the equity cost is the expected return on equity. All right? So those are the cost of on interest on the money you are actually putting inside the company. So if I were to ask you what is the weighted average of, and just change the numbers now, change the numbers and think about this being 1.5%, which will be actually you. Let's think about interest, and this being, I don't know, 15%, which let's think about as an expected return on equity. And I were to ask the question, and now I tell you this will be liabilities and this will be equity, okay? And now if I tell you, Brenda, Brenda, what is the promedio ponderado on the cost of financing of the company? What would you do?
I'm a little lost. I'm catching up. 1 second.
Okay, don't worry. Am I being clear, guys? I feel that I am not being clear. Hello?
Yeah, I'm also a little bit lost.
Where are you lost? Like at
I'm
what
trying to
part?
find the liabilities. The interest expense is within the cash flow, right?
The interest expense and those, do you mean these rates for the homework?
Yes.
Well, those actually in the instructions of the homework. Just let me go. Ooh, I'm sorry. Models. We go here and here.
Okay.
Those are there. Okay.
Okay. Okay. Okay. Yes.
So that's where you find them.
Okay.
That's
That makes more
that's the question you had, Brenda. Where to find the rates?
No. I was just making sure that I had the right rates.
Okay.
Okay. Now I understand where we're at with the other part with your other examples.
Okay. I'm a bit worried that maybe I'm not explaining this as clear as I think I am. So the explanation thus far, it is clear what a weighted average is, right?
Yes.
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 And it is clear now that you are taking the weighted average of the cost of financing the business, which are the assets, right? That's what you are calculating.
Yes. I have a question for the liabilities.
What is the
For
question?
example, for the company's debt, do we take into account the family loans
Yes,
and
of
the
course.
mortgage?
Yes, for this example, you need to take everything into account. You take the equity, complete equity, and you take the liabilities, complete liabilities. We are assuming that these two have. Let me put the balance sheet, all right? Because
So we
that's,
also take into account the total liabilities, for example, the short term and long term
yes,
within the balance?
yes,
Oh, okay.
yes,
Plus
you do it. But guys, and again, this is because of the case scenario, right? It's really important for you. Okay, here is the homework and the answer. Okay, and right. Now, in the case scenario, you have debt, all right, and then you have investment, which is the preferred stock, which is the first investment Fernando did, and then you have the retained earnings. And what are the retained earnings? The retained earnings are the money that the company generated again and went inside the company as reinvestment of the cash flow, as reinvestment of the net income. And if it is a reinvestment, then it is expected to be reinvested at the cost of equity. That is the expected return. That is why we are using these two, okay, for the equity cost. And then you have the debt. And in this case, we have two loans. We just bear in mind that it makes easier the WACC analysis because you know these two are loans, and we can do like a really conservative approach of the analysis and take all as loans because we're expecting all to generate cost. But bear in mind that if you are doing an analysis of another company, you don't necessarily use all the values of the liabilities. because you might have in there vendors or credit notes or some other stuff that for accounting purposes are liabilities, but for financial analysis and cost of money on that during and cost of money during time are not part of the financing activities of the company. So that we need to be very clear on that. If we're, for example, if we were to have the account of vendors, the vendors accounting here, we had to just take that out of the WACC analysis, because that wouldn't be part of the cost on debt the company has. For the homework, yes, we will use both values for the WACC analysis.
Okay.
Yes.
Yes.
So, well, that is the concept of WACC. Other thing I saw some of you guys ask me about is how do we put this inside the formula? Well, tax change between the months, between the years in the analysis. There's actually, this is a pretty straightforward part of the formula. You just put 1 minus the tax corporate rate. And right now in Mexico, it's 30%, but in the case values, one is 29 and the other one is 28. Okay? And you multiply that by the cost of debt, which I think was 1.5. And then you multiply that by the weighted average of debt as a total of the financing for the company. And these are percentage. And you do the same for the equity part of the business, of the formula, but you do not include the tax shield there. Tax shield only affect interests. And you then add them up.
Teacher, for example, in the debt and equity values, you mean that we have to use the percentage, or we have to use the like cash value? I don't know how to explain it.
The monetary value, well, you need to use the monetary value to get the percentage.
Okay, yes.
And then with the percentage, you multiply by the interest rate and by the cost of debt. And let's see that with numbers. You have numbers here. These are the values. You see, Frida? Just think about this as 100K and 200K and 300K, okay?
Yes.
And then, well, you are dividing this over 300, this over 300, and this gives you 33 and 67. This is the same as this apple, this pie here, this pie chart here, all right?
I have a
Yes,
question.
Isaac?
So the tax shield is going to change, like the first year is going to be 71 and then it's going to change to 72?
The what?
The tax shield? Well, in the
The tax
operation?
shield, yeah, exactly. The tax shield will
Okay.
change as, yeah, you are correct, Isaac. It changes from one year to another, to 70 something to 70 other something.
Okay.
It's 70 what? 71 here percent. I mean, it's just that this subtraction. I mean, this 100, right? Minus 28%. This is 72, right?
Yes.
That's what were you asking, right, Zach? Now,
Yes.
this is the answer for the case. Yes, that's the answer we need to use for the case. Where I don't want you to just concentrate on what are the numbers I am supposed to get for this homework and for my project. No, understand the reason why we are doing this. You are doing this because you are reducing the interest effect on your cost on capital. And the reason why is that is because interests are affected by tax. As they are deduction for the business, your tax rate for the interest reduces. And that's why you are reducing it by the tax. That's called the tax shield. Yes? No? Maybe? Can you repeat the question?
The answer is a percent, right?
Yeah, yes, of course.
you're
The answer is a percentage. And just to finish reviewing that, when you have that weighted average, then you multiply just by the rates, because you want to find the 100% value of the pie chart as a percentage of the rates. And when you multiply this one, we need to multiply by the tax shield, and this tax shield was 1 minus 30%. That's why it's 70%, right? So this is a multiplication of this times this is 3%, and this time this one is 23%. The addition of these two is 26, and that is the weighted average cost of capital. In the case, well, you need to calculate it for every month. because, well, it's just for you to practice. And you will end up with like 27 weighted averages. So just average them up and you have the weighted average for the project. Okay? So if you didn't do it like that, please change it and re-upload your answer. And don't worry, guys, I won't be discounting any grade if you upload your answer again today, because I thought that this wasn't clear for most of you when I was reviewing the homeworks yesterday or today in the morning. So anyway, that's the weighted average cost of capital. Yeah.
Only one question more, Christopher. The net present value is positive or negative?
It's positive.
Okay.
Oh, you told us you were going to mention
Yeah,
which
I'm
one for the
gonna
lunch.
mention that. I mentioned that, yeah. So here I was telling you, as you will calculate net present value for the projection, you need to only use the cash in for that. For this, you also need a value for initial investment. Use the pending balance of debt at April 2006 and March 2006 as initial investment. So that's what I was telling you, and you can find the value both in the balance sheet or mentioned in the problem case scenario. And then I saw there is a difference in the values, but it's not as huge as difference as you were guys using. And I saw some of you guys were actually adding up all the investment on assets that Fernando has at the beginning of the project, which is mentioned. Well, this is the Spanish version now I'm seeing. But anyway, they are the same values. So anyway, you were using like the addition of all the assets, the investment on assets. That's like 3 million and something. I don't remember what price that on the analysis at the time. Fernando. Okay, well, it started telling you that, right? 1 million. Then he buys this, and then he buys, that's 1,500,000, and then he buys a brewery, that's another million, and then he spends on implementing changes inside the lease, and that's like another 1,700,000 and something. So if you add those three, you get 3 million and something of pesos. And if we were actually evaluating the net present value of the project at the beginning of the project, like that is when Fernando starts the business, then yes, that will be correct. But we are actually evaluating for the homework, we were evaluating the beginning of the projection. That is on March 2006, where Fernando has to make the decision of selling, leasing, or continue the business with his parent, with a partner. So there, what I told you was use the value of debt at the beginning of the projection, okay? As initial investment, because the assumption we are making is that when Fernando has to leave the business, he has to pay the outstanding debt. In that moment, he has to pay the outstanding debt. So he needs an initial investment of the project for the payment of the total debt, right? I mean, he is gonna leave to France, so he wants to repay all the debt and then just leave or lease or whatever he wants to do. But he wants an upfront payment for the debt. So that's gonna be the initial investment for the business. And what is the outstanding balance of the debt for Fernando at the beginning of the projection, guys?
What was the question?
The liabilities?
The liabilities. What is the question? Thank you, Citare. The question, Isaac, is what is the outstanding value of the debt at the beginning of the projection Fernando has?
750?
750, exactly. And you have two values actually, because I was checking this, and this is incorrect. Maybe it was 750 the previous month, which will be April 2006. So that here is 720. So here is 720, and if you go to the case scenario, it tells you 750, right? Which is the answer. Isaac, you say. So for the homework analysis, it doesn't matter which one you use, because I was going to grade the two answers. I have them here. I will not show you because that's the answer for the case. But if you use 720 as initial investment on 750, it both gives you a positive value of net present value, and it actually is acceptable also for internal rate of return and modified internal rate of return. So for acceptance purposes, it doesn't matter which one you use, as long as it is the values of the debt. If you are using the investment values at the beginning of the project, that is when Fernando bought everything, then you are getting a negative value, which is incorrect. Okay? Because what does a negative value mean for the business? Isaac,
Excuse me?
what does a negative value on the net present value analysis means for the business?
That is not profitable, and instead of giving you revenues, it gives you
Exactly.
debts
So-
or losses.
Exactly. So tell me, Isaac, in this business, and he wants to sell the business, should he give you a negative value?
It doesn't.
No, what I mean is like in your homework, if it gave you a
Mhm.
negative value, does it make sense with the business case scenario?
Nope.
No, because he wants to sell it, right? And he has 3 offers. So, I mean, why is this guy a scammer or what? Right?
Yeah.
Does that make sense, guys? Isaac?
Yep. The only thing that I was going to ask you is in the internal rate of return and the MIR.
Mhm.
Do we need to check also the cash generated in the period instead of the cash at the end?
Yes, for
Okay.
everything you need to take the cash generated in the period. And why we are using the cash generated in the period, Isaac, and not the cash at the end?
Because it's the net value and not the accumulated one.
And yes, but my question is why we are using that value. I mean, as a bottom line of the analysis, why are we using that generated cash?
I don't know.
Because we are evaluating the ability of the company to generate cash.
Okay.
Because
Yes,
cash.
if you let me explain this, we have 2 kinds of variables in finance. Some are flow and some other are stock. The difference between them, you can imagine like the difference between a video and a photograph, okay? A flow is something that happens over a period, while a stock is a variable that is only a picture of a moment. In this case, the cash flow is all the cash that has been generated in a period in this company, while the balance at the end is what is left. Okay, so maybe what is left is also result of previous exercises, or I don't know, maybe it can have other explanations. But what we are trying to know in order to evaluate a project is how much cash was generated in that period. So that is why we are using the cash flow of the period instead of using the balance at the end.
Thank you, Felipe. Is that clear now, Isaac?
Yeah.
And general question for all of you guys. Is it clear why we are using the cash generated in each period and not the balance? I want you guys to answer me these questions. I mean, if only this question, that's enough for the class. Because it's really, I mean, it's the basis of every cash flow, discounted cash flow analysis. So it's really important for the class purposes that you actually understand why we are using the generation of cash inside a company to evaluate its viability. So is it clear for everyone, not just for Isaac?
It's clear.
It's clear, Aldrich. It's clear, Alejandro. It's clear, Andres. Okay, so thumbs up for them too. Ana Paula, is it clear?
Yes.
Carla, Jimena.
Just a good question. So for not for all the companies, we're going to use in this case the it was the financing activities, right? It's just because of this case and how is it managed?
Yes.
Okay.
I mean, it's because here in this case, if you go down, I don't remember where it was. I think it's here. It tells you that you need this, a minimum of 25,000 of debt amortization. And it is not debt, it's actually that Fernando wants to have that money, like available to use to pay debt or to do investment. Because if you read the case, the 100,000 pesos you do investment in cash from the projection, it's not actually already spent. It's just like we are waiting to do that. Okay, so for the characteristics of this case scenario, and maybe if you are doing an analysis of another company and they tell you that you need to use the debt payments as increases on working capital, then you will use them there, and then you will deduct them in your cash flow, because for that analysis, it's being included as discounted cash flow. All right. So in other business, in other analysis, Frida, maybe you need to use them. I don't know. It depends on the basis on the analysis you are doing. In this case, we are using them as increase on working capital. The general formula says you are not supposed to include debt. So that's the formula you need to have in mind. We also need to have in mind that the analysis changes when you are analyzing different companies, depending on the objectives and ideas of the company's analysis. So is that clear, Frida?
Yes, thank you.
Okay. So I'm gonna continue. Mariana Aradillas, is it clear why we are using cash flows generation?
Teacher, I just have a little doubt, just to
Uh-huh.
conclude this. So what I understand is that we have to use the total liabilities as an initial investment instead of the 3 million or something.
Yes, the total liabilities at the beginning of the projection, because the 3 million and something were the total liabilities were at the beginning of the project, which is when Fernando started.
Okay.
So that's why I'm clarifying that, because yeah, maybe there is a little confusion. What I want to make absolutely clear here is that you need to use the debt at the beginning of the projection, which is at March 2006. Okay.
Okay, thank you.
So I have a question here in the chat. It says, for the case we have to use the cash generated in the period of the cash flow or the free cash flow, what is the difference? Well, there is no difference. We are using the free cash flow analysis to evaluate the net present value, but this is linked to the question Frida asked, and with the question we actually opened today's questions, and is why we are using the debt payment as financing activities in the free cash flow. If the formula for free cash flow says we are not supposed to use them, and the answer is because of the characteristics of the analysis is more conservative approach. We are deducting those payments even though you are not doing debt payments. All right, that's the thing. Those are an increase on cash outflows for the project of Fernando's. For these characteristics of the project, it is considered as an increase on working capital, and working capital increases are considered inside the free cash flow. So the difference between the free cash flow analysis and the cash flow statement is basically that the cash flow statement includes payments on debt and payments on dividends and rebuy of stock and all of that. And the free cash flow, you do not include that in the formula. We're inside the case scenario as it is told to us that we need a minimum of 25,000 pesos for amortization of debt, even though it is not a debt payment, it's just an increase on working capital. We are going to include them in the free cash flow analysis as an increase on working capital. And that is why we are including them in the analysis in this case. And bear in mind that if you have other analysis, you need to take into consideration all the assumptions that they are given to you by the case or by the analysis to take the decision. So I don't know if that was clear. Was that clear?
Yes.
Yes. Okay. So is it clear, Sofia, Mila, why we are using cash flow for evaluation purposes, for valuation?
Yes, teacher. And I have
Blanca?
another doubt right
Uh-huh.
now, like for the debt. So I only use the mortgage, so I need to use all the liabilities.
Yes.
Okay.
Blanca, is it clear now?
Yes.
Yes. Sherlyn? I'm gonna ask to every one of you, so better have your microphones on. So Sherlyn, I think she is not with us. Nayeli, is it clear why we're using cash flow? Carla?
Yeah, it is.
Okay. Alejandro? Who else we have here? Aranza, Andres, I think you already answered me to this. It's clear. Okay, so if that is clear, let's move now. Well, I think those are all the questions I had actually. It was just WACC, cash flow, the thing about free cash flows, and the debt as initial investment. And yes, it shouldn't be negative, the net present value for the homework. So please rework that, upload your homework again today, change that answer because a lot of you had that incorrect, so change it, please. If you don't have any other questions, then we will move to today's session, which is scenario analysis and use end analysis for evaluation.
Just before starting, I have a quick question about another rate that we use in the homework, which
Okay.
is, I just want to know, for what do we use MIR?
Modify internal rate of return.
Yes.
That's an analysis, and you need to apply it in what cash flows?
And
I'm asking you now.
all?
It's an analysis on cash flow. With what cash flow do you use? The cash generated in the period or the cash balance at the end of the period?
Generated the period?
Generated in the period, exactly, Frida.
Okay. Oh, okay, thank you.
And it's just a formula in Excel. Remember, if you have questions, you can review the class recording, and you can go here and just find the.
No, I understand how to obtain it. I was just having troubles to understand for what am I using it?
Why you are using it?
Yes, like for what purposes?
Well, because modify internal rate of return implies that you are reinvesting the money at the WACC value, at the value of cost of capital. So it's going to give you a return less than the internal rate of return. It's going to be a percentage, a smaller percentage. So it is like a more conservative approach of analysis when you want to find the return of the project as a percentage of cash flow return.
Yes, if you let me to complete this idea, we have both internal rate of returns, the traditional and the modified. The point of both is that they want to give us what is the profitability of overall the project. But in the traditional internal rate of return, it is considering that the cash flow is being reinvested in the project at the same internal rate of return, okay? But maybe, okay, sometimes in real life, it doesn't happen like that, because imagine that what will happen if internal rate of return, for example, is low, and by policies of the company, you are not allowed to continue with that business if internal rate of return is low, for example. So, or we can find some other situations in which you don't reinvest at the same rate. So modified internal rate of return have some additional computations that we don't do at hand because they are complex. In reality, we don't have an actual formula to do that. We have to do it by trial and error. So Excel is more easy to do. But in modified internal rate of return, the model is assuming that the reinvestment is not done at the actual internal rate of return, but to the return rate that you are giving to the model, which in this case is WACC, between the two of them.
Yes.
Teacher, by saying you reinvest the cash flows, it's like a compound interest, like you're.
Yes, exactly. Yes, remember, we review the time value of money as compound interest for the inflation, compound interest for the rate, and also for the WACC. The cost of capital in internal rate of and modified internal rate of return is reinvested as compound interest using WACC.
Okay, yeah, thank you.
Mm-hmm. So was that clear, Frida?
Yes, thank you.
Yes, okay, that's a really actually good question. I'm seeing a lot of questions we are going to use for the exam. Okay, so there are no, do you guys have any other questions before we move forward to the last two analyses? Last two analyses are really, really simple, guys. So it's not gonna take us more than maybe 10 minutes per analysis. But I don't want to move more forward until I know that everything we've seen so far it's actually clear for you guys. I'm gonna take your silence as yes, teacher. It's everything is clear. Okay, so Next analysis for time value of money, and well, for valuation purposes, it's payback period. And payback period is it's something that we actually use in common basis when we are analyzing investment, because it's a really natural way to analyze an investment. And it's basically how much time does it take the investment to repay the money you put inside the investment. That's the definition. It's really easy. For example, if I were to put 200,000 pesos inside a business, and if I know that each year the business will generate 50,000 pesos, and I have the business, this one year, 2, 3, 4, 5, and 6, in how many years will the business repay my investment? Well, it's really logic. You just add this up, right? This one plus this one plus this one. Okay, here we have 200. So the answer will be in 4 years, the project will repay the investment. Okay, so that is basically the payback, not basically, that is the payback period. And of course, sometimes you don't have like conventional and really straightforward values of cash flow. So maybe you may have 25,000, 80,000, 60, 50,000, 60,000, whatever number of cash flow. So the analysis for analyzing the payback period is not that straightforward. That's why you have a formula. And the formula is number of years prior to full recovery. That is the years when the cash flow has actually almost covered all their initial investment, okay? Plus the unrecovered cost at the start of the year. That is the amount of cash it is still to be recovered from the initial investment, divided by the cash generated in that period, okay? That will give you like maybe 4 point something, 6 point something. That is the complete years before recovery, plus the fraction of the years necessary to full recovery. Let's do an example for you guys to understand that with numbers. So again, it's the same example we are using. That is the investment on a development of a plot of land. And the analysis is, the question is how many years will it take for us to repay the investment for this project? And well, all you need to do is just add this up, and this is 5 million pesos, which is this. So this is our initial investment. And then we just start counting, right? So this is 600, is not sufficient to cover, so we move to the next one. So the addition of these two is not 5 million, so we go to this one. Here we have like maybe 3 million, for 2 million something. Then so it's not enough to cover the 5 million, so we go to this one, and it's almost there. Here it's 3 million something, and then here is 4,740,000. All right. So here we are almost at completion recovery. So this is the year prior full recovery of the investment. So that will be year number 6. Okay. And if you were to add up this, year number 7, then you will be over the payment, right? Because that's more than 5 million. So what you need to do here is you need to divide the difference, which will be 220,000, over the cash flow generated. All right. So it will be year 6 will be this one, and year 7 is 220, which is the difference between this one and this one, which is the initial investment. And why the hell? This is incorrect. This should be 220. I'm sorry. So help me out with the formula. All right, with the value. So this is incorrect. This should be 220,000 over 1080. So this, I'm gonna take my calculator, and it's 220, 1, 2, 3, over 1080. 1, 2, 3. Maybe this was a calculation I did before, so that's why it's different. So that gives you 0.203. Okay, so instead of this, you have 0.03, and the addition of these two is the payback period. So it will take you 6 years, 6.23 years to recover this investment. So that's the payback period, like a nominal value. Okay, it's really easy analysis. Actually, it's actually pretty easy. Is that understood, guys?
Yes.
Okay. Well, I think you didn't understand me because I am seeing that I'm actually making a mistake here. This is all incorrect. It is 260,000. Do you guys see why?
No, can you explain again?
Well, I was thinking it was 220,000 because I was just going, I think a little bit fast. But I'm realizing that I was incorrect. It is 260,000. I was correct here. My previous self was correct when I did this. And the reason is this: 220,000 will be if here at year 6 we have repaid 5 million, and the difference will be 220. But the payback amount is 5 million, so it cannot be 220. So what we are doing here is that if you add this up, this 1, 2, 3, 4, 5 values, if you add them up, you get 4,720,000, right? 740. So the amount left to repay the investment is this one, 260. So it will be 5 million minus 4,740,000. All right, and this one is 260,000. That's where you get this money. So this is only to show you that when you go to year number 7, you overpass the 5 million pesos. So it's just like for showing, it's not the value you need to plug inside the formula. The value you plug is this, and it is the cash left to repay the investment. So now you do take that one and you divide it by the cash generated in that period, which is this one, 1,008,080, and then you get this value. And then you add it up and you get this, 6.24. So that is correct, okay?
So teacher, by the end of the 6th period, the 6th year, you have 4,740,000 pesos or dollars or whatever. And so instead of going right into the 7th year because you would surpass the 5 million objective, you need to divide those years' profits by the difference.
You need to divide the difference by
those years' profits. Okay.
Cash flows.
Oh, okay.
Remember, these are cash flows, not profits.
Generated cash flows? Free cash flows.
Yes, exactly. That's exactly right, Alejandro. So
okay,
I want you to tell me what is the problem with this analysis as we are doing it right now.
Okay, sorry for the interruption. I'm leaving. So have a good day, everybody. Bye. Keep in touch.
So I want you guys to tell me what is the problem we can. I mean, we all been talking about time value of money and discounted and WACC and interest rates free and internal rate of return and whatever. We've been seeing a lot of interest rates here. So what is the problem you may see straight away with this analysis here?
Could it be that maybe you borrowed the 5 million and it doesn't account for interest?
Exactly, Alejandro. That's exactly right. And not only if you ask for a loan for the investment, also if you are expecting a return on the investment, and it is just there are your savings and you are expecting a return, this analysis is not taking into consideration that cost of capital.
Yes.
Okay, it's not taking in consideration the time value of money, which is the bedrock of everything we are seeing today. So this payback period, as it is right now, it is known as payback period at face value. Okay, it just gives you the amount on pesos in that year, but it doesn't take into consideration the cost of capital, inflation, expected returns, weighted average acquisition capital, all of what we've been seeing here as important to do valuation. So we need to do something called discounted payback period, which is exactly the same formula with a little difference. And that difference is that you need to use the discounted cash flows, okay? So let's do the same analysis, but this time we are going to discount the cash flows. So we are going to use the WACC, weighted average cost of capital, to discount the cash flows. And here are the discounted cash flows. Remember, I just applied the formula of future value of cash flows divided in 1 plus the rate, this time will be WACC, at the end period, okay? So in here will be 1,500,000 over 1 plus the rate to the power of 1, okay? So this is this value, right? And I repeat the formula for every cash flow, okay? That's the difference, the main difference here. And then again, we do the same arithmetics, which is you add up all the values until you find about a year where you are almost fully recovered. That will be year number 8. And again, if you go to year number 9, you go over by 300,000 pesos. So you take those 2 years. You know here that you go over there with 400,000, but that's okay. We're not gonna use that year completely. So you take the 4,820,000 and you subtract those from your payback amount, which is 5 million, which is the amount of these two, all right? So you go ahead and use, and this gives you 78,526, okay? So this is the amount you plug into the formula and you divide it by the cash generated. Look, it's the cash, discounted cash generated, because here you are generating 1 million pesos, apparently, but at this cost of capital, it's just it's half the money, okay? It's 500,000 pesos. So you divide those two and it tells you 1.13. So addition, these two added up and it gives you the payback period. And just watch this. Well, this is the formula in Excel in case you don't want to do it by hand. You can just use this combination of cells to calculate the discounted periods here. And I just want you to notice that this is almost 2 years longer than the discounted normal payback period, you see? I mean, that the not discounted payback period, the face value payback period. Because now you're taking into consideration the time value of money. Okay? Okay. So that's the discounted payback period. Last analysis we're gonna see for time value of money, it's terminal value.
Can you go back? Sorry, teacher, can you go back 3 seconds? Just,
Yes.
okay. Thank you. Yeah, we're good.
Okay. We are all good, right, guys? Are you all understanding this?
Yes.
Okay, perfect. Okay, so the last analysis is terminal value, and I want you to, I don't know if you guys have actually gotten your classes on finance mathematics, but if you have, I want you to take to remember this this analysis that is called perpetuity. And if you invest in a bond, for example, and that bond pays a dividend, that dividend is a cash flow. And that analysis of perpetuity of the bond payment each year, it's called perpetuity analysis. And that analysis has a lot in common with the cash flows, because cash flows are actually a payment, right? I mean, you are expecting to get paid that money each period. And if you think about it, business are supposed to last forever. I mean, you want your business to last forever. Just think about Coca-Cola, for example. How old is Coca-Cola company? Or thinking of other businesses, like really old business, JP Morgan, for example. We were actually seeing Morgan Stanley, that's a bank, that's almost like 200-year-old bank. Banamex is also, Banamex is a bank, it's a Mexican bank, it's a really, really old bank. It's like almost 300 years, I think it is Banamex, because it's one of the first banks founded here in New Spain. So it's a really, really old company generating cash flow like on perpetuity. Also, other companies, what other companies you can think of that actually started a long, long time ago and are still generating cash flows? Tec de Monterrey, you know, it's also a company. It's like 75 years old now. Can you think of another company that is really old and is still generating cash flows?
FEMSA, or the companies inside FEMSA?
FEMSA and the companies inside FEMSA, yes, they are really old, those two. So if you think about it, sometimes companies are actually outliving the founders, right? So you can think of them as perpetuity payments. And a perpetuity investment, as I told you before, is actually a investment vehicle used in wealth management, which is you invest on assets that actually pay a bond. I mean, that actually pay a dividend. The most common assets for that analysis are bonds, but you can also use that analysis for cash flow analysis, because if you see the perpetuity value here, the present value of the perpetuity is exactly the same formula we are using to evaluate cash flows. You see, it's exactly the same formula. Instead of cash, I mean, here this is cash flow, but it's not the payment of the bond, it's the cash flow generated by the business. And you actually have a discount rate, which in our case will be WACC. And you have two types of perpetuity payments. You have the perpetuity payments where the cash flow is always the same. This is the most common perpetuity payment when you do wealth management. And then you have the perpetuity payments where the cash flow are increasing each month, you know, they are increased cash flows, or they move on an exponential basis. And for that, you have this formula, this perpetuity analysis, okay? And this other formula for constant values each month. So which perpetuity payment are we experiencing in our cash flows generally, guys? The constant payment or the increased payment on perpetuity?
Sorry, what was the question?
Which cash flows are we experiencing in our analysis? Constant payments or increased payments?
Increase.
Increased payments. Yeah, that's actually pretty common on business. So this is the formula we are going to use to evaluate net present value of a business evaluated on perpetuity. Okay? This is an analysis using cash in corporate finance when you are analyzing a business that you are expected it to grow on perpetuity, you know, to last forever, and which is the case on most business when they just reach a certain amount of time. I mean, for example, FEMSA and its companies. I mean, it's a company that is not going, it's going nowhere. I mean, it's going to survive crisis, presidents, whatever it takes. I mean, it's just a huge company and will go forever. So for them to analyze cash flow, it's actually, it will be really hard because they will have like a lot of cash flows periods for analysis. So what they do is they do a perpetuity analysis. And then let's go back to the business we were analyzing, which is the investment on a plot of land to develop apartments and rentals for commercial estate. And now let's think that there is a perpetuity growth of 3% in this analysis. Just for the sake of the analysis, we are going to assume a 3% rate, which is actually inflation. So if you remember this example analysis, at year number 10, my friend is saying that he wants to sell the building at 5 million pesos, which is what he invested on the first place. So he's saying at year 10, I'm going to sell the business at 5 million pesos. And we already know that a discounted cash flow, those 5 million in 10 years are actually worth 2 million today. So it doesn't seem like a good idea, right? To sell the building at 5 million pesos. So maybe my friend comes to me and tells me, hey, I want you to tell me, now that I've seen this, I've seen what is the value of the 5 million pesos in year 3 discounted to this period, I mean, to actuality. I want you to tell me I want you to tell me a fair value of price for year number 10, or when I sell this business, right? So as I am seeing that this building will keep generating rent payments for like perpetuity, I can tell him, don't worry, I will help you. And I will do a perpetuity analysis. So I will take the cash flow and I will take out the last year, which had the cash generated by the sale of the business, and I will apply the formula, okay? So we know the formula is the cash flow at year number 9, which is the last year, which will be this one, times the growth of the cash flow expected, discounted by WACC minus the growth, okay? That is the formula we're gonna use to calculate the value. And we are expecting a growth, which is at least inflation. So we take the cash flow at year number 9, which is 1,080,000 pesos. We increase it by the growth, which is 3%. That gives us 1,112,000. And then we discounted by the WACC, which is this one minus the growth, which is 3%. You see it here. And that gives me the net present value of the perpetuity. So a fair price for this building, as it's going to be generating cash flow for perpetuity, will be 26 million pesos. That is the price I will advise my friend to consider as a sales price for his building. He can also tell me, well, it's good that you are including inflation there, but actually it is not. I mean, I'm not expecting. I mean, I cannot tell my tenants that their rent will increase at perpetuity 3%. I mean, some increases on rent are actually expected, but in some cases it's really hard to increase the lease on contracts, even more if the contract is on the long term, maybe 5 or 10 years. So why my friend tells me, I want you to evaluate the value of my business without growth. Well, then I can just plug in the values. It's a lot easier. Just take the cash flow at year 9 and then just divide it by the WACC. Okay, so this will be this one, and then WACC will be this one, and then I have my other price for selling of the building. And I can tell him, okay, if you are not expecting increases on money, also not taking in consideration inflation, then the fair price for this asset when you sell it is 14 million pesos, right? And it actually makes more sense if you think about it, of prices of other buildings being sold here in Querétaro that are actually for rent. It's like those prices. So that is the terminal value of an analysis. And I want you to go ahead and calculate the terminal value of the project with a growth rate of 6%. So let's calculate it together, right? Let's do that because homeworks were not that clear. So maybe we can do it together, and when you need to do it for the final project, you can see what is the process you need to follow. Before I move to that, is this clear, guys? Do you have any questions regarding terminal value?
No.
Okay, so let's do this one.
Teacher, the growth rate, like, it's just, I was thinking, who determines the growth rate, like the business itself?
You can determine it by analysis of the market. You can use a beta analysis, and I mean that would be for risk.
Okay.
You can use like a market share increase. I mean, if you go to the case, you have actually the growth on sales here. You see it?
Yes.
And they took this from analyzing some stocks. I remember. I think it was Modelo and some other. What was that? Here, you see? There is an increase here and a rate. So look, I actually took the 6% there from here. It says market risk premium, which is the expected return investment on the Mexican stock market has. So it's 6%. So that's where I took the value for this. But you can take it from ever. I mean, it depends on the analysis you are doing. In this case, we are taking the value given to us by the case. Yeah?
Okay.
So let's calculate it, okay? This one is my WACC. And I have my last value, which is this one. And remember, these are months. So if I go ahead and multiply this by 12, I have the cash flow generated where? When? Because these are monthly cash flows, this will be my yearly cash flow, right? This is my year. And remember, perpetuity is years. So that will be the case for this. But anyway, I'm gonna take it as monthly because my WACC is also monthly. So this in this case, I'm gonna take it monthly. So the formula is I have this one, and I'm gonna increase that one by the growth, which is 1 plus 8, which is 1 plus 6%. Yeah. I'm sorry, I don't know what's happening. And then I'm gonna divide that by. I'm gonna divide that using my WACC No, that's not correct. The thing here is happening is that perpetuity analysis is for year, and also I have my yearly growth. So I need to analyze this WACC. So wait for me a second. I need to analyze my WACC for this. So I have it here. Only WACC, and I'm gonna take this formula. I'm gonna put it here. What this formula is doing, so this is a monthly, right? I'm gonna teach you how to do this actually today, which is a scenario analysis. You just let me do it here so we can. And I want this one to be 0.0156 by changing this one. Okay, so this will be my yearly amount of WACC, and this will be my monthly WACC. Okay, now I can do the analysis. Okay, now I have this times 12, and that is the yearly amount of cash flows, year cash flow.
But why it's 20 instead of?
Because this one is monthly, and all of these periods are in months. And remember, you need to be in the same time frame. With perpetuity analysis is year, so that's why it wasn't going to work if I don't analyze the rate, the WACC. And this is the formula to de-analyze the rate, which is actually you take you decompound the rate at the monthly rate, and that's the formula I have. So I just use what if analysis to find the value of the year. And I will show you how to do what if analysis, because that's actually a topic for a scenario analysis. Right now, just trust me, this is the value of WACC in the year. And when we are doing, if we were doing WACC analysis, I mean, net present value analysis for years, that's the one we will need to use, because all these WACCs are monthly, okay?
Yes.
Who asked that, by the way?
Me, Frida.
Frida? Okay, so just believe me on this, Frida. And what I need to do now, it's for the perpetuity, I need to increase this one by the growth now. Now I can do it because now it's yearly growth, and I have my values on years. The previous analysis I was doing was wrong because it was monthly. And this is my yearly growth, okay? And then now I discount it as a perpetuity. So I divide that by the WACC minus the 6% growth I am expecting. And there is the value of the business, 5 million pesos. Okay? That is a more fair value that Fernando can use to sell his business if he's expecting the business to last forever, as we were just saying. So that's how you calculate terminal value of a business. Okay?
We multiplied the first 57,000 by point.
By 12. First we multiply by 12 because this is monthly, and the perpetuity values and the perpetuity analysis is yearly. So we need to take everything to years. That's why we also do this with the WACC. Because this WACC was monthly, which is actually the one generated here. So we turn it into year. Yeah?
Yes, sir. Thank you.
And this will be year cash flow with growth. Okay? This will be discounted perpetuity payment. Okay. Okay. So that will be that. Correct. Okay, so let's recap. We introduced capital budgeting analysis. Now we know what that is. We talk about net present value, a time value of money. We actually saw quite a few analyses of that, with the last one being terminal value. Then we review internal rate of returns, the modified internal rate of return, the incremental internal rate of return, and crossover rates. And we also review what is payback period and discounted payback period. And all of these classes have been to evaluate a business, right? A business decision or a business project investment.
The next part of the course is to evaluate options to take the best financial decisions. So that is, well, one of the tools you have to do that is a scenario analysis. As I told you before, this is a really fast, I mean, this is a really easy topic to understand, so don't worry, we don't get to this completely. We can see it next class also, but it's actually, I'm going to start it explaining it to you because it's part of the curriculum, but it's really easy because it's what you've been doing so far. A scenario analysis is what you've been doing so far in all your classes for financial statements and financial analysis. So let's start first with what is scenario analysis. I want to talk about business intelligence, and then I'm going to show you some tools in Excel to do a scenario analysis. First off, what is a scenario analysis? Well, a scenario analysis is when you take values and then you estimate the value of that analysis in the future. We are doing that with the cash flow analysis. We just take what we expect to be the sales, what we expect to be the cost and the expense. We determine a net profit, and we just calculate the cash flows with those estimations. And you do that just to look for the most likely case scenario or the unlikely case scenario, and then to build a simulation. And this is part of strategic planning. Even if you don't commit yourself to a finance career, if you go to any part of business analysis, you will need to construct scenarios, and you will do a scenario analysis, which is just using basically Excel or other software tools to simulate growth in the scenarios. So that is a scenario analysis. It's just what you've been doing thus far, which is just take Excel, project sales, project costs, project expenses, build your net profit. All of that is a scenario analysis. A scenario analysis, it's the very composition of a scenario analysis is scenario building. And a scenario building is divided in four stages. First is collect and organize the information you will need to generate the scenario, which is the discounted cash flow for these classes. After you have all the information, you need to identify the variables you will be changing to actually plug them into formulas and complete the scenario result. After you have all the formulas, then you need to create the assumptions you're going to be evaluating. And now, once you have the assumptions, you generate the business questions, or the business questions can actually generate the assumptions. These two are actually in a full cycle, because as you move forward in the analysis, changing the business questions, you actually change the assumptions you are doing in the scenario. And let's think for a moment in the business case problem we are reviewing. The information we collect at the beginning is the financial statements, the information inside the case, all the information is spread inside the business case. Then we identify the variables. We have identified a few, which are inflation, expenses, percentage of sales, growth, interest, cost of equity and investment. All of that are variables that will actually modify the result we have in the scenario analysis. And then we have to select assumptions and generate business questions. And think about I have a question. I'm sorry, guys. Are you watching? What slide are you watching on my screen right now?
It's a list of 4 things that says scenario analysis.
Okay, perfect. Because I for some reason in my PowerPoint it's stuck at objectives. So sorry for that interruption. I was telling you, think about the scenario we have right now, the problem case scenario. In this scenario, we do have actually assumptions already. The assumption is that Fernando needs to leave, and he has 3 options to take into consideration. And the business question is, which is the best option for Fernando if he leaves? Will he be better off if he just sell the company, or maybe he can just lease it to someone, or he can continue it as with a partner, which will be his dad in that scenario. So those are the assumptions, and that are the options he has to take into consideration. So let's see them in a little more detail. As I was telling you, collecting information for this is just creating databases to generate reports of analysis. And here you have financial information, operative reports, that is cost analysis. Industry outlooks, for example, are the expected returns we have for the markets. We have that also in the scenario, a 6% rate. corporate governance structure because maybe you have to pay dividends or something. This is used a lot in mergers and acquisitions. Anyway, the thing here is you collect all the information you need to build your scenario. That's the first step. Second step is now that you have all the information, you need to identify the variables that you're going to be changing. And the way you identify those variables are the information you think it's going to be important to change for you to evaluate the different scenarios. And I here have some examples. For example, community prices of labor costs is really important to include as change in the analysis because that can change a lot in the business. General expenses as well, consumption and price inflation, stability, of course, and also legal and public risk. For example, forex exchange. If you are a company that imports a lot of goods and you use the dollar as a currency to import the goods, change on forex will be a huge risk for you to take into consideration in your analysis. And then once you have all the information and all the variables selected, then you select the assumptions and you create the scenarios. And it will be increases on prices, on direct costs, decreases on demands, possible reduction of capital, cost of capital. Maybe you have an investment and you are considering an angel investor to come in the business and do an investment. Or also you can have an assumption where you merge or acquire a business. And here the tools you use to do that are Excel, ClickView, Tableau. In general, this is called now business intelligence, and these are business intelligence software. The main idea of all of this is to generate business questions and what if analysis. For you to generate good assumptions, then the main goal is to analyze the business questions you have. That is possible outcomes, possible risk, all the things you need to implement in your model. This is actually called business intelligence. Business intelligence is all the process of a scenario building for financial analysis purposes. That is collecting the information, categorizing the information, and presenting that information in such a way that the stakeholders of the company can take a decision. So if we were to see that as a complete, just really easy diagram to understand, you will have the business data in one end, and then you have all the information used to transform and create and generate the scenario building here using this huge like bubble of tools, different tools you can have. And it's the corporate finance professional who actually take that information, manipulate the information, and construct the scenarios to present to the board of directors, business units, or general shareholders of the company. So that is the scenario analysis. As I told you, it's really easy. It's just if you think about it, it's what you've been doing so far all these months, years, because you're actually, I think, in third semester, fourth semester. So each time you have a financial analysis course, that is for cost analysis, for internal finance, or even for market analysis and stock prices, buyouts, and portfolio investment, what you are doing there with Excel is actually generating a scenario analysis, because what you want is to take the best possible decision given the information you have and the outcomes you are expecting. That is a scenario analysis. Do you guys have any questions? No? Okay.
Not right now, no.
So that is a scenario analysis. And what I want to show you now are two tools for scenario building inside Excel that you can actually use and are really useful. I just use one right now in front of you guys, which is GoalSeek in the scenario analysis. I'm going to show you two, which are the ones that you mostly be using in here in your academic life. Of course, you might use them. You might use them as tools to just answer homeworks and stuff, but also they are really powerful tools in professional financial careers. Those are a scenario manager and GoalSeek. So we still have time. We have like 20 minutes, but I don't want to rush it. But also, I don't know if you guys want to just be done with this or just see it next class. So I'm gonna ask you, do you want me to explain how to use this in Excel now, or should we wait until Tuesday to see them? I think we should wait.
I think we should wait.
Yeah, I think we should wait.
I'd like to wait too.
Okay, so we're gonna wait for that. Just an introduction for these two, it's enough. And that is, these are tools you can find in Excel, and these are actually really powerful and useful tools for you to do a scenario analysis and a scenario building. Okay, so if there are not any other questions, we will end class here. Remember, if you saw something that you did wrong in your homework, re-upload it today. I won't be penalizing uploads today, like late uploads. It will be taking us the full credit. But do change the information in case you did you committed an error. As I'm giving you an extra day to deliver the homework, now I won't be so obliged to just consider small errors in the homework, because I am telling you basically everything you need for the correct submission of the homework answer. So please change that if you see it fit. If not, just leave it like that. I will be reviewing homework during the weekend, so you can have the answer so you can have your grade next Tuesday. So if you don't have any other questions, guys, we will leave the class. We will just end the class now. You don't have any other
Thank
questions?
you.
Teacher, there is no homework, right?
What?
There is no homework, right?
No, I the homework there, I don't want to ask that. I'm gonna change it to maybe a forum for next week. Just concentrate on this one. And the reason is because it's very important for you guys to really apply this on the homework, because next week you need to work on your final project. All next week is gonna be just about your final project and answering, because we only have 2 more classes, because the last 2 classes are the exam and then the review. Okay, so please work on your homework.
And when do we have to upload the homework again? Today? By today?
Yes, I mean, if you want to change something, you can upload it again today. If you don't want to change anything and you're just like, nah, I want to say it like that, you can leave it like as you delivered it yesterday. That will be okay. If you want, of course.
Teacher, can I stay really quickly with you?
Yeah, I mean, we have 15 minutes, guys. So if you have any questions or you want to stay, go ahead. If you don't want, you can leave. The class is over. It's okay if you leave. Don't worry.
Thanks, teacher.
May I share my screen really quickly?
Yes. Let me give you. Who is talking?
Yeah.
Okay.
Okay.
Share your screen.
Just really quickly. So for the WACC, what I did is put the equity, the total liabilities, and add them up. Then I have the percentage of equity, the percentage of liabilities, and I decided to just multiply it in here. And for the WACC, I just put this plus this, and I multiply it by the corporate tax.
But I think you are multiplying the equity by the tax shield. And do we have any other people here? Okay, who can tell Aranza what she's doing wrong in her WACC?
Can you select your formula, please? She's missing.
She's applying the tax shield, but where is she applying the tax shield?
In the equity, probably, or left, because she's missing an one, I think so.
She's applying the tax shield. Thank you for that. She's applying the tax shield on you are applying the tax shield on the equity, and the tax shield is on interests, debt, cost of debt.
Okay, so what is wrong is this part?
You tell me. You change it as you want it. What I'm telling you is the error I'm seeing is I think you are applying the tax shield in the wrong interest rate, in the wrong rate.
So tax is with the debt, is with liabilities?
Tax shield affects the debt, yes.
Okay.
And also, where are you using the 3 million pesos investment?
The 3 million, I'm not taking that into.
No, I mean for the net present value. You're going to change that, right?
This one? Yeah.
Okay. Well, what I mean is that.
Oh, sorry. Continue.
What I mean, thank you, Brenda. What I mean is, why are you using in line 107? Because I am taking that your net present value. Double click on your net present value formula, please. So why are you using that cash flow and that amount of initial investment?
Oh, I got it. Why am I using that? I don't. That's why I don't know what
Can I help her?
Yes, of course, please.
So it's because, can I say in Spanish, please?
Yeah, go ahead if you want. I mean, I am
Ah,
contractually
este-
obliged to speak in English, but if you want to speak in Spanish, you can.
Es que es porque justo era lo que estábamos viendo al principio y hace cuenta que, o sea, el caso establece algo así como una deuda de no sé cuánto, o sea, como un initial investment de no sé cuánto, pero el valor que tienes que utilizar es el del periodo y puedes utilizar los 750,000, que son los que están en el caso, o tus total liabilities de marzo del 2006, que son los 720,000. Entonces, en vez de 3,250,000, el valor de tu initial investment, por así decirlo, son o 750,000 o 720,000. O sea, dice el profe que las dos respuestas están bien, entonces...
Ah, ya. Ok. Entonces, esto no es, esto sería más bien...
igual, o sea, ponla como, exacto. Y ya nada más, pues que sea negativo para... Y ya.
Okay, and which cash flow are you going to be using to do your net present value?
This one.
And you understood why, or you are just doing it because?
No, because this is the cash generating period is the value that the company is having.
Okay, perfect. Yeah. Nice. Okay. Yeah, that's the error that maybe half of you did. You took the end cash at the end of the period.
Yeah, I realized that I did that on my homework, and when I click on it, I realized that I put this one.
Yeah. So change it.
Una
What
pregunta.
what is the question?
Go ahead.
Is it okay if I don't have the last two? Can you go up a little bit, please? If I don't have the cash at the beginning and at the end in my Excel?
In your Excel, it's okay. The reason why I put that there is for you guys to review your cash flow was correct. So did you guys change? I mean, I forgot who is presenting. Aranza, right?
Yes.
So Aranza, did you replace your balance sheet with the balance sheet I uploaded in the homework?
Yes.
Yeah.
Okay. So take the 72,000 and go down on line 108, column D.
Mm-hmm.
Column D.
Column D.
D. Use right equal. And then just take the above cell, the 72,000. 72, not 720,000.
72,000.
Okay, and then subtract, do the subtraction sign, and subtract the balance amount on banks on the balance sheet. So go up to the balance sheet, find the balance on banks, and subtract it in the same period. So there. Go up. So it's cash and cash equivalents there, and enter. So just forget about if it is a difference on cents, it's okay. That's because Excel is rounding. Well, go up to where it says accountabilidad on your Excel. No, go down. You were right on your spreadsheet. Go with your mouse. Don't scroll. With your mouse, go up. Yes, to the taskbar, and then go. No. Don't click anything. Go to your task bar, to your tools bar, and above where it says contabilidad. Do you see it?
Insertar, dibujar fórmulas.
Go hit a little bit more to the right, down. Contabilidad to the there. Okay, now no, wait. Go down. Don't click there. You just go down, and then you see those zeros, like those little there. Now hit that one. I'm sorry. Hit the other one. There. Okay, now if those two are zero, it means your cash flow is correct. So take that small square at the bottom left corner, right corner of your cell that is in the below the 72,000, and just drag it to the right to all your cash flow to the end. Okay. See, I mean, there maybe you had an error on your cash flow, on your depreciation, or maybe you did something wrong with your inflation increase on the expenses, because it's actually in January when you have the error. You see, so that's why I gave you those two lines, so you could actually review if your cash flow was correct. Because the subtraction of those two values has to be 0. And if the subtraction is 0, then your cash flow is correct.
Okay, I will check this.
So who asked me that actually? I didn't see who.
It was me.
Who?
Abigail.
Abigail, okay, so Abigail, that's why I gave you those two lines. I mean, it is not, I will not be grading if you add those two lines, but it's for you guys to find out if you did the calculation of cash flows correct.
Okay.
Okay,
thank you.
Now, going back to Aranza's question, review your formula for WACC, because what I'm seeing is that you are applying the tax shield on the incorrect rate. So please review that, because that will make your WACC incorrect. And if the WACC is incorrect, then everything is incorrect.
Ok, entonces, para decirlo, el corporate tax es en sí lo que está mal.
No. Corporate tax is correct. It's the tax shield. Where are you applying the tax shield?
En este, ¿no? O sea, que lo estoy multiplicando por este. Es que no entiendo muy bien.
Ah, no, you
Yes.
are multiplying it by the interest rate. I'm sorry. No, wait.
Okay.
Can you double click on the point 86%, please?
86%.
So that is
Equity.
That is your equity?
My equity, yeah.
No, the thing is that I am confused, because I am seeing there on column B that it says liabilities in front of the 1.17%.
No, this is
No, but it's cost of equity, the one on top, right?
Yeah.
Okay, and then you have cost of debt there, 1.50. Okay, now I understand. Okay, escape, please. And double click on there. I mean, review your formula, because I don't know, I'm getting confused by the way you have your values organized. But do review your formula and make sure that the tax shield is applied to the interest rate. I mean, that is to the cost of debt. Okay.
So we can just like put the values in the formula like as it is.
What? Well, yeah, you can just look the values in the formula, yeah.
Like we don't have to do like she did it, like the percentages and all of that.
Well,
like, is it okay?
I don't understand.
Can we just like, if we have our, like the ones you gave us, the 1.5 and the 1.171, we can just plug them into the formula with the initial values from liabilities and assets, and that will be okay?
I mean, if you get to the correct result, yeah, that will be okay. I mean, what she's doing is she's just separating the formula to better comprehend the formula, which I think is good. I mean, I did the same in when I answered this.
Teacher, no vas a lanzar.
Just explain quickly. O sea, lo que hice fue poner equity, liabilities y sacar el total. Después aquí abajito puse el equity entre el total y los liabilities entre el total. Después de esto lo multipliqué el equity, o sea, este porcentaje por el CE y ya me dio, y después los liabilities, lo que me dio aquí, por el CP. Y ya para el bueno, aquí lo que hice fue 1 menos 0.29, que es el tax rate para el 2006, y el tax rate para el 2007, que es 0.28.
Okay.
Y ya para el WACC lo que hice fue que es equity por CE, más liabilities por CD, por este tax. Y así es como saqué el WACC.
Okay.
Teacher,
But I have a different result, okay? So I think you have something wrong in some of your rates, or maybe you are, I mean, I will review the formula, because the process you are describing is correct, but I'm getting a different result.
I got the same result as Regina.
Yeah, me too.
tax rate.
No, I think I get. Well, no, yes, sorry. But for the ERR and MIR, I was just wondering, can you give us like, it has to give us less than, I don't know, what percentage? Can you give us that clue?
No, wait. I'm sorry, Aranza. I was watching I was seeing the WAC at the first month,
Yeah.
and I was comparing it to your average monthly WAC, which of course are different numbers. But yeah, that's correct. That's 1.1431. So it seems to be correct. I don't know if the average is correct because I'm not seeing that number right now.
I think I have to do it again.
Okay, so sorry, who was asking something? I'm sorry I interrupted you.
Frida, no, it's fine. I'm just wondering if you can give us a clue about, like, for example, if the ERR and the MIR have to give us like less than, I don't know.
No, that will be to give you the answer, guys. What I can tell you is that the project is to be accepted. So you cannot have either a negative NPV or a IRR lower than the WAC or a MIRR lower than the WAC. The project is acceptable project, and it is not an $8 million project net present value.
Okay, thank you, teacher.
Do check
I have
that
one
because
quick
the net present value is not as big as your.
No, sorry, no. No me haga caso, profe. Ahorita nada más le estoy haciendo.
Okay.
Al todo, pero sí. Bueno, muchas
Profe,
gracias.
tengo una pregunta rápida. Para inflación, ¿sí es 0.03?
Yeah, that's 0.3%.
Because I have I'm looking at the differences and I was not taking into account inflation for the unions, but on the bottom in my cash flow, I have like after the second year that I'm doing something wrong because
let me see if I use the correct rate, because I mean I'm a human, I can also make mistakes. Just wait. No, yeah, it's 3%. I use 3%.
okay, because for the second year I have negative numbers. For example, I have negative one. No, if I don't apply it on the unions, then I have increasing numbers.
You have negative numbers in your cash flow?
No. You know how you find the difference between the last.
Oh yeah, the cash flow and the balance. Yeah.
For example, for the second year, I have positive numbers. For example, like 5, 10, 15, 21, 26. If I don't apply the inflation on the union, but once I apply the inflation on the union, then I just have a -1 throughout all of them. Yeah,
I mean that's an error on the inflation on that rate. Yeah, it should give you 0 or really close to 0. Just like difference by decimals it's okay. That's because Excel is rounding. When I converted the balance sheet I sent you to values, Excel rounded up, so that's why you get a difference on decimals. But it should be really small. Not if you get 1, 10, 5. That's an error.
I have -1, but I don't know why. I have -1 a partir de, maybe it's because of the depreciation.
Perhaps.
But
maybe you are applying the inflation on the depreciation.
No, I'm not. But I checked that. I'm not. But the thing is, for the depreciation, after the 2 years that change the K and L, we keep the same depreciation as L, right?
Oh, well, we don't have cash flows after 2007, so I don't understand if you are asking that. I mean, it will change again 3% more, but we don't have cash flows 2007. Goodbye, Aranza.
Bye.
I don't understand your question, Brenda.
Okay, ya ves que en la
do you want to share your screen?
I can't because I'm on my phone and on the computer.
Okay.
But I can connect if you want.
No, I mean whatever is easier for you. The thing is that I don't understand the question.
Okay, you know how you bought assets. There's a change in 100,000.
Yeah.
In the filas L and M, right? And that
Yes.
changes your depreciation.
Yes.
Or K and L. So K and L changes, but in the column M, do you keep the same depreciation as the column L?
Columns. Can you tell me better, like the names? Like you're using P&L correctly, but I understand. Column what?
2006 2007-09, 2007-10.
2007. Well, yeah, in 2007, I don't have changes on depreciation. It's just the two changes you have in 2006.
Or yes,
Increases.
2006-09, 2006-10. You have those two increases. Now 2006-11, do you keep the depreciation that's in 2006-10?
2006-10. Yes.
Yes?
Yeah, because you don't have any more investment on CapEx, so you don't have a change on depreciation.
That's the only, or because in 2006-11 is when my cash flow, no, 2006-10 is when my cash flow starts to have a -1. And
What
then
is the
it starts
value
to
you
have
have
a,
on depreciation in 2006-10? October 2006.
I have, one second, 28,000,
Uh-huh.
28,750.
That's the same amount I have, so it's not depreciation. I think you have something else. I will review my formulas if I were you. I mean, I know that number is correct because Frida had the same questions and we reviewed it together.
Yes, and
So check it. I mean, the balance sheet that you have now, that's with the balance in. Well, you say it's 1 peso, right?
it says 1, yeah. But then it goes, it's
Not
1
that
from
material.
K. It's 1 from K from 2006-10, October. No, it's 1 from 2006 October to,
And then does it increase, like difference increase when you change years?
when I change.
When you change years, when you go from 2006 to 2007, do the difference
No, it
increase?
stays the same. It stays the same until, one second, 2010, 2007. That it
So you
increases
have
to 2.
something in the formula you derive. Because if you see, I mean, what I'm hearing now is that you have an increase on the change basically at the same month in the next year.
Yes.
So there's something weird with your formula. I will review the formulas.
Okay. Thank you.
Yeah. You're welcome, Brenda.
Bye.
Bye-bye.